morning, everybody. Welcome to the Trading Market Technicals morning call video for Tuesday, January 22nd. Hope everyone enjoyed their long weekend. Back to the markets. Last week we had another gain across the board, as you can see here in our on the boards. Dow Jones, S&P, Nasdaq down ever so slightly due to Apple, but that'll eventually change, and Apple and the Nasdaq will decouple if Apple continues to have some issues. Russell 1.37%. Look at the sectors down below, and as you can see here, green across the board except the drug sector. Healthcare actually up. Consumer staples up as well, not on the board here. Utilities up as well. Really, really weird, as you can see. I mentioned last week we talked about healthcare and the consumer staples, money rolling into that as well. So that gives us definitely a warning sign. However, healthy long-term view of the market itself. And we're going to run through that again on Mondays. I like to take it out a week, month, and just see where we are. So where are we? Well, on the longer term view, we are constructively bullish, and we remain bullish. Short-term trend remains to be on the upside. So therefore, there's no sense fighting the trend. However, we do have some red flags. Our indicators are telling me that, and on the charts, that we are possibly in for some sort of a market correction, some sort of market pullback. Now, that being said, we can correct 3%, 4%, and the market still be bullish. So please keep that in mind. For the longer-term investors managing their 401ks, their IRAs, or just longer-term view of the market, there's really not much to do. If you are into hedging your portfolio, then I would recommend buy puts against your or inverted ETF. Just for a hedge. On Friday, something very unusual we talked about, and I'll show you on the charts. The VIX actually literally collapsed on Friday. So that is another warning sign. So we could have tons of warning signs, but if there's no catalyst, we have no sellers in the market. Market volume has been light, although it did pick up the last couple of days on this market upswing. So we just still want to be alert and aware. And if you are looking to build long positions because you do think longer term the market's going to run higher, really isn't good to be building positions at these areas, or at least starting to. We want to wait for some sort of a pullback. And if it goes without you or I, then you have to set aside and say it is what it is, because taking longs and adding to longs is one thing, but it's starting a new position, swing trading at these areas here. Again, we've been up almost every day since January 2nd. To me, tells me that we are extended, and all you need is one little thing before the markets really start to roll over. So enough said on that, but again, just be careful. I like to pick my spots, and I like to look for trades, the best setups for the day, 3, 4 trades, 5 trades, 1 trade for that matter. If there's nothing that I see, cash is a position, I move off to the sides, and I get my day ready for the next day. And I observe, and I start scanning for stocks. Okay, now, let's take a look at speaking of that, let's take a look at the sector. And as you can see here, 1 week's performance of the top sectors. Utilities even up, which is really weird. Healthcare even up. Technology being down, and then obviously services, industrial goods. So we do have some real nice turn as far as what's happening here in light of the sector performance. Indices, as you can see here, Dow Jones, big day. Nasdaq ever so slightly. S&P, the mid caps is really nice. I like to see that, as well as the Russell 2000. That's something really, really good. Oil ended the week really, really strong. XLE actually broke out a little bit, so that's a sector that I'm going to be looking to watch and looking to play. And we'll start talking about specific sectors in the upcoming videos as well. And I'm going to be announcing some new changes and new stuff on the website come this week as well in a morning call video. All right, so now what I want to do is I want to go into some of our indicators, and the first thing I want to do is I want to show you our S&P 50-day above stocks above the 50-day moving average. 90%. It's a little bit too rich for me, and as you can see here, we've literally have travel up vertically, and this is something that to me again is a warning sign. Now again, price is what pays. Price is king. Indicators are secondary. They're lagging the price, so just keep that in mind. But it also does a great job of saying, hey, maybe I might tighten my stops if I'm swinging, a trade 1 to 5 days. But this is something that gives you definitely a warning sign. Okay, so let's take a look at our new highs. Basically, can't get any higher than 100%, right? So we're right up in here as far as the indicator goes, is 100. It has ticked there for the last 8-9 days and hasn't moved anywhere. So again, this is something just to take note of, that if you are looking for something, I'd be looking for more of a pullback. Our trusty NYMO, McClellan Oscillator, excellent, reliable chart. This tells me that we are not really overbought yet, this indicator, although one big spike up would probably get us into an overbought state. Anything really above 70 or at the 70 level is definitely a warning sign, along with the other indicators telling us, hey, look, you know what? We're kind of stretched here, and once our NYMO gets up to that area, then I think everything else will follow suit, and that should put some sort of a short-term top, at least a tradable top. Okay, don't forget, long-term, we're bullish. Longer-term structure remains bullish unless something changes, unless we have a catalyst. We want to follow the trend. The trend is our friend. I can't stress that enough. I would not be looking to pick a top and be short here. All I would say is that if we are looking to short and trade a shortable top, look to get short a top here, we want to make sure that the market ticks higher, closes lower, and then follow through the next day on a daily chart and takes out that low. That would be the cue to look to get short, saying, hey, we might have at least a 2 to 4% pullback in the market, and then look to rebuy and re-enter the market at lower levels. Okay, so now I want to talk to you about the NASI, and as you can see here, we were flatlined 2 weeks ago, and I said we didn't get that sell signal yet. Sure enough, curl right back up again, and we're back up above it now. We're way at these areas, as you can see. So we want to be cautious, and we want to say to ourselves, you know, I'm not looking to start buying this market here, but this does a great job of indicating market tops and bottoms here. If you could see, if you could just follow this area here. Okay, new highs, new lows. Showed this to you last week as well. Again, 1485. Market was closed today, Martin Luther King's birthday, although electronic trading was on, and we did close higher yet again. So to me, this is, again, a word of caution. When you get to these lofty levels here and they start spiking, you will get some sort of a pullback, whether it be a mild or a small pullback, and that's going to be addressed when we do get that pullback. We'll monitor and see where we go. Is it just a small correction, or is it impulsive and there's something bigger to that pullback? More than likely, to me, the way things are going, we'll probably get a small little pullback, and I'll show that to you in the charts in a moment. But I'd love to see that happen. Then we can come in and look to buy the market again. Here's the 10-year yield, as you can see, 1.87, back of this rising trend line. If this starts to take off, there's going to be another area, another example with our indicators to say, hey, you know what? Yeah, I think a lot of these market participants are going to look to start taking some profits. So again, another area. S&P with the ATR, we're down to 12 now. Really the average true range, literally just grinding higher on no volume. And this is what never short a dull market is what they say, and that's exactly true. And as you can see here, we popped up and we just grinded higher, and the ATR continues to fall and drop. And when you get to these areas, you got to use caution, because once the ATR starts to roll back up again, you're going to get that market sell-off here again. So just another word of caution. Again, another thing on my toolbox that I like to see, just kind of check, sort of, quote, under the hood of the market, the breadth of the market, what's the state of the market in general. Even though we're short-term, we still want to see where are we, where we're going. Do we get aggressive here? No, or are we at the lows where we can get aggressive and look to buy stocks with both hands? That's what I like to see on the charts and our indicators and our sectors, and what the sectors are reading and telling the trader. Okay. Next will be the U.S. dollar, and I want to get into some. I got a lot of emails talking about other currencies, and I just want to briefly touch on really what's happening here. We have our U.S. dollar, and we do have the longer-term picture of that. On the weekly chart, you can still see here on the daily, we have a head and shoulders pattern here, here, and here. Again, only valid if it breaks a neckline, and the slanted neckline would come in somewhere around 79-ish. So right now, this is still bullish, and it's just hanging here into this horizontal channel. So we really need a break above this area, and eventually, I kept talking about it, I think the dollar will decouple from the equities market, and will go up with equities. And the only reason why I think is that eventually the relationships actually do change. Now, we also talked about how I think the dollar will actually rise in the short term, is because we have our three safe haven currencies, or were three: the Swiss franc, the Japanese yen and the U.S. dollar. Well, the Swiss franc, the Swiss government actually intervened last year, pegging it to the euro, so that went away. The Japanese yen, the new government actually intervened, and I'm going to show that to you now. As you can see, have literally decimated the yen. Now, if you look here, and here's our ATR 14, we're starting to pick up. So the guys that like to trade Forex, in the short term, I do think in the longer term, yen will have continued weakness because of the intervention. However, in the short term, I do think that being the stochastics below 12, when anything below 20 is really oversold, I think it's going to be a good term, at least a tradable bottom in the yen pairs, which would be shorting the yen pairs to get short long the yen. So something to think about for the longer term view. Take a look at the euro. As you can see here, kind of drifting up higher here. Really can't break out of these highs. So watch the euro too as well. I like to be well-rounded and see what's happening in general as a whole world economy that we are now in. So this is something that we're still bullish, still constructive here, and we're just sitting in this channel. So a break lower in the euro would actually put a strength in the dollar. So therefore, if there is a risk-off type sentiment or catalyst, meaning the market participants, will flock to the U.S. dollar, and you'll have dollar strength, market weakness, and commodity weakness as well. So again, that's the relationship now, what we see, and we'll continue to monitor that when and if that does change. Okay. Now let's take a look at the VIX, and then we'll go right into the chart. And as you can see here, we broke down and literally collapsed. We broke below this. I've never seen it this low in 25 years in this market. So this here broke this channel, and now we're at the lows. Look at the stochastics. Literally unbelievable. I've never seen it like this before. Total complacency in the markets, guys, and I keep saying that, and I understand, and repetitive. We have to be repetitive in this, what we talk about, and repetitive patterns actually plays out. So we are right now at extreme complacency levels. As a contrarian, that's also a sell signal. Just keep that in mind. All right. Now let's go right into the charts. Take a look at what we have here. 5 sectors that we follow. Key sectors: S&P, Russell, transports, NASDAQ, Dow Jones. I look at as a Russell and a Dow transports, the two leaders. Dow being the leader, then a Russell, then a NASDAQ, S&P, and then a Dow. Okay. Now if we look here, we have exactly what we want. We have the Russell in blue, following, transports up, and then obviously NASDAQ being the low because of Apple for now, but everything else looking really, really well. So to me, this is looking constructively bullish. Of course, we want to see a pullback. A pullback in this market is healthy because if you continue to grind like this, the pullback just gets a little more scarier to a lot of other people, and then everybody starts to exit at once, and then you get a deeper retracement than a normal constructive, 3 days up, 1 day down, 3 days up, 1 day down. Where if you continue to go up, it becomes that much harder on the sell side. Okay, meaning that harder you get, the harder fall. So anyway, I wanted to bring this to to show you. Very constructive here in the long term for the longer term investor. This is still actually good. There's no signs really to get out of your positions, mutual funds and or ETFs. Now let's run into the charts real quick. Here's a weekly chart of the spiders. I like to show the spiders because of volume, and as you can see here from 2009. We did have 2 weeks of increased volume, which is also good. It's a good sign to see. We're at the highs here, so let's see if we can really break out and at least test this upper end of this channel here. And as you can see, repetitively, right, we hit the channel down, channel up, down, while we're making higher lows, higher highs and higher lows. So this is actually bullish. Bullish configuration still intact. Okay. Now let's take a look at our spiders. And now I've shown this inverted head and shoulders for back in December, and I see a lot of people now showing the inverted head and shoulders, and really doesn't do much good for the longer term person if you're showing it now. We've been showing this for quite some time, and this is actually a valid pattern. We're looking at 151, this pattern in the spiders, and again you can see this on the daily chart. You take a look at this, is exactly what you want to see here, is volume increasing on the way up. And not that it's anything to write home about, but Friday we did have some decent volume here. And that's the reason why, was because we had options expiration. So that's another case. But nonetheless, the other days we did have some increase in volume. So that's something that I'd like to see. Again, overly bullish. Can't really say anything much about it, about the market. It's just very low volume and no volatility for a lot of momentum traders, day traders. It's a very tough market to do anything because markets aren't really doing much. And I shouldn't even say just the markets, but a lot of stocks aren't really moving quite quickly as you'd like when you're in a trade and you're trading for 6.5 hours a day. Okay, inverted head and shoulders on that S&P 30-minute chart. Just wanted to show you a break back up here. So we've been literally grinding higher since January 2nd on the fiscal cliff resolution. Now, if we take a look at our cash, here's our weekly chart, and we're just breaking out into this. Now, we're not quite overbought, in our weekly indicators, okay? We're getting there, but we're not quite overbought. So there is more room to run, believe it or not. I know it sounds mad, but it really is plenty of room to run to the upside. And if we look at our daily chart, and our daily chart here does measure, and I'll show this to you on the 16 and 30 minute chart, low 1500s, 1513 I believe it is. But again, our momentum is waning. CCI is just below 100. When we were breaking back of it, you could see here. So this is, I like to look at the CCI and different indicators to really kind of judge what's going on, but still constructively bullish. Early last week, I came on and said, look, guys, we have negative divergence on a 60-minute chart. Let's see if it plays out. Now, and what I mean by let's see if it plays out, we need a break, and a break would be below this trend line. This was early last week, somewhere around here. We did not get it. We broke to the upside, so negative divergence did not play out, and that's why we don't want to jump the gun. We want to get our signal, and then we want to get our confirmation, whether you're trading for the long term or if you're trading for an hour or if you're scalping. Doesn't matter. Same game plan strategy holds true. Different risk reward and different management, obviously, but everything still holds the same. And as you can see here, 30-minute chart, look at what's happening. We're just grinding, and all of a sudden we broke back up. We popped for one day, we rolled back down, and then we closed up higher into the close on Friday, where the big portfolio money managers, hedge fund guys, readjust their portfolio going into next month, and that's also due to the options expiration as well. Okay, diamonds, Dow Jones ETF. Nothing wrong about this, just to me, and all of these charts. There's nothing wrong with these charts at all. And I did mention, I believe it was on Thursday or Friday morning, saying, guys, be careful because the markets generally are bullish on options expiration. And actually, not only the day, but for the week. You get a couple of small down days, and then you get more up days on options expiration. But just something that I wanted to bring out to you. Say, we're overextended here, 95. We're just under 1, and we're sitting at the highs here. So a nice little flag pattern, maybe down into that 133. I'd love to see it touch the 20-day moving average. But again, we'll just continue to monitor it. IYT, beautiful, exactly what you want to see if you're bullish in this market. Transport just continue to take everything else with it. It is a leader, regardless of what you trade. And if you don't trade it, you need to know what the transports are doing. IWMs, Russell, again, very constructive, move higher. Again, lack of volume on the IWMs, but still, if you looked at the S&P 400 and the IWMs, the Russell 2000, still really bullish. I do love these patterns. I would just like to see a little bit of a pullback. If we do get a 3-4% correction, then there would definitely be a buy-in in the market. No question about it. Let's take a look at Apple. Apple struggled last week. Really can't get out of its own way. They're going to report, and by the way, I might mention, a lot of earnings this week. So if you are holding positions, please check the earnings calendar. You don't want to roll into a wall here, wake up one morning and the stocks, up or down 15 points because you didn't check earnings. Please check earnings. Apple does report this week. It's going to be really interesting to see what happens with Apple. It really is going to be interesting. As taking a guess, I think it's going to flush, and that would be a flush to push down, and then Apple kind of corrects itself, and then we get our first target would be right around the 590-600 area, if that were to happen. So I'd like to see a buy-in right now at the 460-ish. That would be my target. Here's the daily chart. Bullish falling wedge, the the headed shoulders pattern down here measured down to the 460 area. That's where I'm looking for. I'm also looking for the stochastics in here to roll back up and the MACDs to turn up and an increase in volume to the upside. So this is not what I like to see. I'd like to see us make this higher low, hold this pivotal area, if we can. And if not, 460 runs all the way back down to this area. Let it break back down, roll back into this bullish falling wedge pattern. So we have two, right? We have a head and shoulders bearish pattern, and we have a bullish falling wedge, which is the bullish pattern. So I'd like to see us break, capitulate, and then roll back up again, and then really break out of this trend line, which is really coincides with a 50-day moving average. So that's what I'm going to be looking for in Apple this week as well. Q's weekly chart, really not doing much. Again, Apple holding it back. That'll change eventually, and then here's a daily shot of the Q's. I know it's a little bit longer video, but I wanted to get that out to you. I wanted to give you a longer-term picture. Again, longer-term, bullish. Short-term is uptrending, and we are bullish, but momentum is waning, so we could turn on a dime at any given day. All right? I want everybody to have a great week. Be safe out there, and we'll talk to you tomorrow. Take care, everybody.